Airbnb generated $1.7 billion in pure, unadulterated cash in just the first 90 days of this year. I mean, it's just staggering.
Yeah, it really is. It's a massive mountain of money.
Right. But behind that mountain, the company is quietly tearing up its own app interface. They're acting increasingly like a boutique hotel chain, and they're preparing to fundamentally alter their corporate structure by phasing out traditional middle managers.
Completely reinventing themselves, essentially.
Exactly. So today we are opening up the hood on their Q1 2026 earnings call to figure out exactly why a company this profitable is aggressively reinventing itself. Welcome to a special Talk Tickers edition of our Deep Dive.
Glad to be here for this one.
We're going to cut through the Wall Street jargon, look at the actual mechanics of corporate growth, and, decide what all of this means for you, the retail investor.
We really are looking at a fascinating inflection point here.
Yeah.
I mean, the Airbnb of the post-pandemic travel boom, the one defined entirely by revenge travel and remote work, that company is essentially gone.
Yeah, that narrative has totally played out.
Right. What we're analyzing today is a platform attempting to transition into this AI-driven ecosystem scaling behemoth. They are making moves that suggest they no longer view themselves as just an alternative accommodation platform.
They want to be the foundation.
Exactly. They want to be the foundational layer for global travel.
And Wall Street expects absolute perfection from a company with this kind of brand saturation. I mean, Wall Street wants to see the top line revenue growing, they want to see the margins expanding, and they want a compelling story about the future.
They want it all.
They do. So we are going to start by pulling apart the headline numbers from Q1. Because before we can evaluate the narrative, we need to see if the math actually holds up.
Let's get into the numbers.
I want to look directly at the top line growth. In the first quarter, Airbnb's revenue hit $2.7 billion. That represents an 18% increase year over year, which, actually came in above the high end of management's own guidance.
Which is a solid beat.
It is. But the metric that really illustrates the sheer scale of this operation is the gross booking value, or GBV. That number reached $29 billion for the quarter, up 19%.
Yeah, the scale of processing $29 billion in 90 days is, well, it's difficult to even conceptualize.
It's massive.
It is. And for anyone evaluating a marketplace business for the first time, distinguishing between gross booking value and revenue is the absolute first step. I mean, they tell you two completely different things about the health of the platform.
Think of it like a massive credit card processor. Like if you go to the grocery store and spend $100, Visa processes that entire $100, right?
Right.
That is the gross booking value. But Visa doesn't keep the $100. They keep maybe $2 or $3 as a transaction fee. And that smaller slice is their actual revenue.
That's a perfect analogy.
So for Airbnb, that $29 billion GBV is the total economic activity. It's the nightly rates paid to the hosts, the cleaning fees, the local occupancy taxes, basically every single dollar that a guest swiped their card for.
And the $2.7 billion revenue is the slice Airbnb carved out for itself. It consists of the service fees charged to the guest and the host.
Right.
What stands out to me here, though, is the tandem growth. Both the total volume of money flowing through the ecosystem and the revenue Airbnb is extracting from it are growing at nearly 20%.
Which is pretty wild at that scale.
It is. Sustaining that kind of percentage growth when your denominator is $30 billion, it requires a massive continuous influx of either new users or, significantly higher engagement from existing users.
Which brings us to the most critical debate for retail investors looking at travel stocks right now, the quality of that growth.
Always the big question.
Are we seeing 18% revenue growth because millions of new people are taking trips? Or are we seeing it because the platform is just passing along massive inflation to the consumer? Let's break down the volume versus price equation.
Let's do it.
So the volume metric, which they report as nights and experiences booked, grew by 9%. Now, management noted it would have been 10% if we exclude an approximate 100 basis point headwind caused by the ongoing conflict in the Middle East.
We should probably pause on the concept of a basis point headwind. Management teams use this terminology constantly to explain away missed targets.
Yeah, translate that for us.
So a basis point is simply 1/100th of a percentage point.
Yeah.
So 100 basis point headwind just means the geopolitical situation dragged their global volume growth down by exactly 1 full percentage point.
Ah,
It's just a helpful, specific way to quantify macro level drag on a business.
right. So meanwhile, the price metric, average daily rate or ADR, was also up 9%. And I'm looking at these two numbers side by side. 9% growth in the actual number of nights booked and 9% growth in the price per night.
Yeah.
If my nights booked only grew by 9%, but my total revenue jumped 18%, it seems like Airbnb is heavily reliant on simply charging people more money.
I see where you're going with this.
I mean, if you are just riding the wave of global inflation and pushing prices higher, you eventually hit a ceiling where the consumer balks and just decides to stay home, right?
That is the primary bear argument for the entire travel sector right now. At what point does the consumer tap out? But if you look at the underlying mechanics of that average daily rate increase, it paints a slightly different picture.
How so?
Well, while the headline ADR was up 9%, the CFO clarified that a significant portion of that was a foreign exchange tailwind. If you strip out the impact of currency fluctuations, the actual average daily rate was only up 4%.
Okay, let's make sure the mechanics of that are totally clear. Airbnb operates globally, collecting revenue in euros, yen, pounds, reals, all of it. But they report their earnings to Wall Street in US dollars.
Right. And when the US dollar weakens relative to those other currencies over the course of a quarter, the foreign cash Airbnb holds suddenly translates into more US dollars on their income statement.
Even if the price of the actual trip didn't change.
Exactly. Even if the actual local price of an Airbnb in Paris or Tokyo hasn't changed by a single cent. It's an accounting reality that can make a company's growth look artificially inflated or deflated if the dollar is strong.
So the true inflation-adjusted price increase that the consumer is experiencing is only 4%. That changes my perspective entirely.
It's much more reasonable.
A 4% increase in the actual cost of a stay is quite moderate. It basically tracks with standard economic inflation over the last year. It means Airbnb isn't, like, aggressively squeezing its users to manufacture earnings growth.
Oh, not at all.
The 18% revenue jump is a highly balanced equation. You have 9% more physical nights being booked by actual humans, 4% real price growth, and the rest is currency translation benefits and minor fee optimization.
It indicates durability. They're demonstrating pricing power, meaning they can raise prices by 4% without losing customers while still expanding the total user base. But, the top line is only half the story.
Right. Let's look at the bottom line.
If we move down the income statement to profitability, we start to see exactly why institutional investors are heavily anchored to this stock.
I call it the war chest. We need to look at adjusted EBITDA and free cash flow. So adjusted EBITDA hit $519 million, which is up 24% year over year. But the truly staggering figure is free cash flow.
The $1.7 billion.
Yes, it came in at $1.7 billion for the quarter. And if you look at the trailing 12 months, they have generated $4.5 billion in free cash flow. That represents a 36% margin.
Which is incredible.
And they didn't just sit on it. They actively repurchased $1.1 billion of their own stock in Q1 alone.
For anyone building a long-term portfolio, free cash flow is the ultimate arbiter of a company's health. Net income, which is the traditional bottom line number most people look at, can actually be incredibly misleading.
Case in point, Airbnb's reported net income for this quarter was only $160 million. If a retail investor simply pulls up a stock screener and looks at net income, they see $160 million. Then they see $1.7 billion in free cash flow, and they assume someone is cooking the books. I mean, how can the gap between those two numbers be that massive?
It comes down to generally accepted accounting principles, or GAAP, versus the actual cash entering the bank. Net income includes numerous non-cash expenses.
Like what?
Well, it includes stock-based compensation given to employees, which dilutes shareholders but doesn't pull cash out of the corporate checking account. It includes the depreciation of assets over time. But this quarter, the massive drag on net income was a very specific one-time accounting quirk related to taxes.
Yeah, management called out an adjustment to certain deferred tax assets due to changes in the U.S. corporate alternative minimum tax.
Right, so corporations often have deferred tax assets on their balance sheet. Essentially, they are credits they can use to offset future tax bills. When the U.S. government changes the tax code, specifically the alternative minimum tax rules, the assumed future value of those credits can change. JAP rules force the company to write down the value of those assets immediately on paper.
Ah, I see.
So Airbnb had to take a massive hit to their net income for the quarter, even though not a single physical dollar left the company to pay that tax. It's purely paper noise.
And free cash flow strips all of that noise away. It takes the operating cash flow and subtracts the capital expenditures, the money required to physically keep the lights on, buy servers, or fix the plumbing in their corporate offices.
Exactly.
The $1.7 billion is the raw, unadulterated cash that is freely available to management to deploy.
And generating a 36% free cash flow margin is the hallmark of an elite asset-light marketplace. I mean, Marriott and Hilton have to pour billions of dollars into acquiring land, pouring concrete, and refurbishing lobbies to grow their capacity.
Airbnb doesn't own the real estate.
Yep. Exactly. Their capital expenditures are essentially limited to engineering salaries and server space. For every $100 in revenue they bring in, $36 drops straight to the bottom line as cold, hard cash.
And they are deploying it aggressively into stock buybacks. They retired $1.1 billion worth of shares in just 90 days.
Which is huge for investors.
It really is. When a company buys its own stock and retires it, the total number of outstanding shares shrinks. So if you hold 100 shares of Airbnb, you don't have to do anything, but your shares represent a slightly larger percentage of the overall company because the denominator got smaller.
Right.
It artificially boosts earnings per share and supports the stock price. It is the ultimate signal that management believes their own stock is undervalued.
It's a phenomenal way to return capital to shareholders, particularly when you are generating cash faster than you can reasonably invest it into new products. But there was another financial move discussed by the CFO, Ellie Mertz, that might seem contradictory to a retail investor.
Oh, you were talking about the debt issuance. They highlighted that they received an investment grade rating from the major credit agencies and subsequently issued a $2.5 billion senior unsecured debt offering. I look at this and think, wait, you just told me you generated $4.5 billion in cash over the last year. Why on earth are you going to the bond market to borrow $2.5 billion and take on interest payments?
It seems entirely counterintuitive to personal finance logic, right? If you have cash, you don't take out a loan. But corporate finance operates on a different plane entirely.
Break that down.
Securing an investment-grade credit rating is a massive corporate milestone.
Yeah.
It means agencies like Moody's or S&P view Airbnb as highly stable, meaning they can borrow money at incredibly low interest rates.
So they are borrowing because the money is cheap, not because they are desperate to make payroll.
Precisely. By tapping the corporate bond market now, they establish a track record with institutional debt investors. It diversifies their capital structure so they aren't relying entirely on equity markets.
Makes sense.
Moreover, it optimizes their weighted average cost of capital. They can borrow at very favorable rates today, park that $2.5 billion on their balance sheet, and use it for massive strategic acquisitions or to weather a severe macroeconomic crisis down the line, all without having to touch their core operating cash.
So it is highly strategic financial housekeeping.
Absolutely.
Yeah.
Okay, so the foundation is rock solid. The revenue is growing through balanced volume and price increases. The cash flow is historic, and the balance sheet is fortified. But numbers do not exist in a vacuum. They are the lagging indicator of consumer behavior and technological shifts.
You have to look at the product.
Right. Let's dig into the story behind these numbers, starting with the consumer app. Nights booked specifically on the Airbnb mobile app grew 22% year over year. App bookings now account for 63% of all their global bookings.
That's a huge shift.
It is. And Brian Chesky was very clear that this is not an accident. They are actively designing the ecosystem to force users off the mobile web and into the native app.
Moving a user from a Google search on a mobile browser into a downloaded app is perhaps the single most valuable conversion a tech company can make. The strategic implications for their long-term competitive moat are just massive.
If I search for hotels in Rome on a mobile web browser, Google owns that interaction. They surface Booking.com, Expedia, and Airbnb, and whoever pays Google the highest toll via search ads gets my click.
Right, you're renting the customer.
Exactly. But the moment I download the Airbnb app, I am walking inside their walled garden.
You are giving them permanent real estate on your most personal device. And once that app is installed, the economics of customer acquisition completely invert. Airbnb no longer has to pay the Google tax to get your attention for your next trip. They have direct, unfettered access to you via push notifications.
Chesky specifically highlighted that a growing percentage of their user base is opting into these notifications, and I actually see this on my own phone. They send highly targeted nudges based on my browsing history.
Give us an example.
Like, if I was looking at cabins in Vermont last week, I suddenly get a notification that prices for Vermont cabins have dropped for the weekend. It is a zero-cost mechanism to pull the user back into the booking funnel.
It creates a closed loop of loyalty. You bypass the open internet entirely. The 22% growth in app bookings indicates that their strategy to incentivize downloads, often through app-exclusive features or slightly smoother checkout flows, is working.
It's all about direct distribution.
Right. They are securing direct distribution, which protects their margins from being eroded by search engine advertising costs.
So let's talk about the specific feature inside that app that is acting as absolute rocket fuel for their growth right now. The Reserve Now, Pay Later option. Here is a massive metric from the call. 20% of their global gross booking value in Q1 came from Reserve Now, Pay Later bookings.
Wow.
1 out of every $5 processed on the platform utilized this feature.
The adoption rate of this payment structure is staggering, and it really underscores how heavily consumer psychology influences major purchasing decisions. Altering the timing of the payment has fundamentally changed how people interact with the platform.
Vacations are inherently stressful purchases because they are expensive and often require planning months in advance. Asking a family to drop $3,000 in February for a beach house they won't step foot in until July is a massive psychological and financial friction point.
It ties up their liquidity.
Exactly.
Yeah.
By introducing Reserve, now Pay Later, Airbnb allows them to lock in the reservation with a fraction of the cost up front, deferring the balance until a few weeks before check-in.
And management highlighted two major behavioral shifts resulting from this. First, they are seeing significantly longer lead times. Consumers are booking their trips much further in advance because the immediate financial penalty is removed.
Which means Airbnb is locking up calendar share early. If I book my summer Airbnb in January, I am no longer shopping around on Hilton or VRBO in April. They take the customer off the market entirely.
Exactly. And the second shift is arguably more impactful, a mixed shift toward larger, more premium properties. When you spread the cost of a purchase out over time, the marginal increase of upgrading feels negligible to the consumer.
It's the exact same psychology used at luxury car dealerships.
Oh, for sure.
If a salesperson demands you write a cash check today for a vehicle, you are likely going to choose the sensible entry-level sedan. But if they offer you a financing plan where you can reserve the car today and pay in installments,
suddenly upgrading to the premium SUV with the panoramic sunroof and the leather seats feels completely justifiable.
Exactly. You are upselling yourself because the immediate pain of the transaction is mitigated. Consumers are looking at a 3-bedroom house versus a 4-bedroom house with a pool, and because they don't have to pay the extra $500 today, they choose the pool.
The analogy is spot on, and there's a critical accounting nuance tied to this that retail investors must understand, or they might misread the balance sheet. When a guest utilizes Reserve, now Pay Later, Airbnb secures the booking, but does not collect the bulk of the cash up front.
Right. The CFO, Ellie Mertz, explicitly called this out. She noted that this payment structure temporarily depresses a metric called unearned fees in the first quarter. Unearned fees represent cash collected for trips that haven't happened yet.
Right.
Because the cash hasn't physically arrived, it makes Q1 cash flow look slightly lower than it would have historically.
But that cash isn't lost. It is just shifted down the timeline. Those deferred payments will flood into the company's bank accounts during Q2 and Q3 when those guests hit their payment deadlines prior to their summer trips.
So it's a trade-off.
Management is making a highly calculated trade-off. They're willing to delay cash collection by a few months in exchange for significantly higher total booking volumes and larger average transaction sizes. It is a brilliant lever for expanding the overall pie.
So we have the app driving direct traffic and deferred payments driving larger basket sizes. Let's look at where geographically this growth is exploding. The core markets like North America and Western Europe are highly saturated. They are steady, but they aren't doubling overnight.
The real narrative is in the expansion markets.
Right. Growth in first-time bookers accelerated to 10%, which is the fastest rate they've seen since 2022. And markets like Brazil, Japan, and India are growing at roughly twice the rate of their core markets.
The strategy driving this international acceleration is internally referred to by Brian Chesky as Project Hawaii.
I love that name.
It is a fascinating departure from how giant tech companies typically handle global expansion.
Normally, when a typical Silicon Valley behemoth decides to expand into a new continent, they usually just translate their website into the local language by massive amounts of generic television advertising and, assume their product is universally appealing.
Yeah, the old playbook.
But Project Hawaii is the antithesis of that. What are the actual mechanics of this strategy?
The premise of Project Hawaii is that travel is intensely cultural, and a one-size-fits-all platform will fail to capture the nuances of local consumer behavior.
Okay.
So instead of global marketing campaigns, Airbnb creates small, elite, cross-functional teams consisting of engineers, designers, and marketers. They deploy this team to a single country with a hyper-specific mandate: study the local culture, identify the exact friction points preventing people from using Airbnb, and re-engineer the product for that specific market.
It is localization on an atomic level. They gave a brilliant example regarding their expansion in Germany. The Project Hawaii team discovered through user research that German consumers have an exceptionally high threshold and demand for cleanliness.
Yes, that was super interesting.
A property could have a great location and a great price, but if the cleanliness metrics weren't immediately obvious, the German consumer wouldn't book it.
So the team didn't just run ads about clean homes. They fundamentally altered the user interface, specifically for users in Germany. They reconfigured the search results to hyper-highlight cleanliness ratings, moving user reviews about hygiene to the very top of the listing page.
Wow.
It seems like a minor UI tweak, but it directly answered the primary anxiety of that specific demographic, and conversion rates just spiked.
They executed a similar strategy in Brazil, but focused on financial infrastructure. In Brazil, the consumer credit economy is heavily reliant on installment payments. It is culturally standard to pay for almost everything, from electronics to travel, over multiple months.
Right, the payment culture is totally different.
The Project Hawaii team realized that offering standard credit card processing wasn't enough. They had to deeply integrate with local installment payment gateways and systems like PIX to make the checkout process feel native to a Brazilian consumer.
And it worked.
Once they removed that financial friction, the Brazilian market began compounding at over 20%. They are treating a massive global platform as a collection of hyper-local startups.
It is a highly capital-efficient way to grow. They identify a market, deploy the team, fix the local friction, watch the metrics accelerate, and then just move the blueprint to the next country.
Which naturally leads us to perhaps the most controversial strategic shift discussed on this call. It is a pivot that fundamentally challenges the core identity of the company. Let's talk about the Trojan horse strategy. We need to talk about hotels.
This is wild. For a company that literally built its multi-billion-dollar brand on the ethos of living like a local in someone's spare bedroom, aggressively pushing traditional hotel inventory is a massive philosophical departure.
The numbers are undeniable, though. Boutique and independent hotel listings on Airbnb are growing at more than double the rate of their core home sharing business. And the metric that management loves to highlight is that 55% of guests who book a hotel on Airbnb eventually return to the platform to book a traditional homestay.
That's the hook.
But I have to interject with some heavy skepticism here. Chesky compared this evolution to Amazon. He said Airbnb selling homes is like Amazon selling books. It is just the first category, and eventually they will sell everything related to travel.
Right.
But Amazon selling blenders didn't dilute the experience of buying a book. Travel is different. People flock to Airbnb specifically to avoid the sterile, generic hotel experience. If I open the app and I am bombarded with boutique hotels, Delta SkyMiles partnerships, and rental car offers, doesn't Airbnb just become another generic online travel agency?
It's a huge risk.
Are they not terrified of slowly morphing into a carbon copy of Booking.com or Expedia?
Brand dilution is the single greatest existential threat to this strategy. If they lose their design edge and their unique inventory, they lose their moat. However, the rationale provided by management is rooted in the sheer size of the total addressable market. Chesky pointed out that Airbnb currently accounts for only about 1 in 10 nights stayed in accommodations globally.
Meaning 90% of global travelers are still choosing traditional hotels, resorts, or other platforms. The ceiling for pure home sharing, while massive, still leaves the vast majority of the travel economy on the table.
Precisely. Integrating hotels solves 3 distinct, massive problems for Airbnb. Let's look at the defensive angle first. Consider cities like New York, which recently implemented Local Law 18.
Right, the short-term rental ban.
Essentially, yes. It acts as a de facto ban on short-term home rentals, requiring hosts to register with the city and abide by incredibly strict occupancy rules. Airbnb's home inventory in New York plummeted overnight.
If a traveler wants to go to New York and Airbnb only has a handful of expensive compliant listings, that traveler is going to open the Expedia app instead. Airbnb loses the customer entirely.
But by aggressively onboarding compliant boutique hotels in New York City, Airbnb retains that user. They remain relevant and functional in highly regulated urban markets where traditional home sharing is under legislative assault. It is a defensive maneuver to maintain geographic coverage.
Okay, I understand the defensive play. What is the offensive strategy behind it?
The offensive play is entirely about customer acquisition. There are millions of older, wealthier, or more risk-averse travelers who simply refuse to stay in a stranger's home. They demand the predictability of a front desk, daily housekeeping, and standardized security. They are never going to book a treehouse or a spare bedroom.
But they might book a highly curated, aesthetically pleasing boutique hotel.
Exactly. If Airbnb can leverage its brand cachet to get that hesitant traveler to download the app just to book a boutique hotel, perhaps a unique property they couldn't easily find on a massive cluttered site like Booking.com, they have successfully pulled a new demographic into their walled garden.
And then they convert them.
Yes. And the data validates the theory. 55% of those hotel bookers eventually cross the chasm. Once they are comfortable with the app interface and the booking process, they're significantly more likely to try booking a home for their next trip.
So the hotel is literally a Trojan horse. They wheel the familiar, safe concept of a hotel into the user's phone. The user accepts it, and once they are inside the ecosystem, Airbnb introduces them to the wider world of home sharing.
Exactly.
But why do the hotels want this? If I own a boutique hotel in Charleston, why am I giving a cut to Airbnb?
Because independent hotels are being ruthlessly squeezed by the traditional online travel agencies. Booking.com and Expedia operate as an effective duopoly in many markets, and they charge exorbitant commission rates, sometimes up to 20 or 25%.
Which kills their margins.
Independent hotels are desperate for alternative distribution channels. Furthermore, to get visibility on traditional OTAs, small hotels often feel pressured to join massive franchise flags, losing their independent identity. Airbnb offers them access to millions of high-intent, younger travelers with a completely different commission structure.
And a platform that actually celebrates their unique aesthetic rather than burying it in a list of generic hotel chains.
Right. It works for the hotels, and it acquires users for Airbnb.
It is a brilliant lever, assuming they manage the UI so it doesn't feel like a cluttered strip mall, which perfectly transitions us to how they are actually building that UI and the internal revolution happening at the company. Every single tech CEO mentions artificial intelligence on their earnings calls right now. It is a prerequisite to keep the stock price up.
Oh, absolutely.
But Airbnb is actually delivering hard operational metrics regarding AI integration.
They really are. They are completely bypassing the buzzword phase and embedding large language models into the fundamental operating system of a company. The efficiency gains are tangible.
The numbers they shared are wild. Nearly 60% of their engineering code is now written by AI. Management estimates that this is roughly double the industry average for tech companies.
That's a lot of automated code.
Furthermore, their AI customer support agents are now resolving over 40% of user issues entirely autonomously, without ever routing the ticket to a human being. That is up from roughly a third just a quarter ago.
And the cost savings there are massive.
Right, the direct result of this automation. Their cost per booking actually decreased by 10% year over year in Q1. In an economic environment where human labor and server costs are rising, Airbnb is actively driving its operational costs down.
To understand how they achieved a 10% reduction in cost per booking, we have to look at Brian Chesky's philosophical approach to AI. He views it as a structural accelerant that necessitates a complete redesign of the corporate hierarchy. He discussed this concept of founder mode.
Right, a term coined by venture capitalist Paul Graham after observing Chesky's management style. What does founder mode actually look like in practice for a $100 billion company? It sounds like a Silicon Valley catchphrase for micromanagement.
In many ways, it is the deliberate destruction of traditional Taylorism and the middle management layer. In a legacy tech company, you have layers of executives who sit at 30,000 feet. They don't write code, they don't design interfaces, they manage spreadsheets, allocate headcount, and delegate tasks in a chain of command.
Right. If an executive needs a data report, they submit a ticket to the data science team and wait 2 weeks.
But AI fundamentally democratizes that data access. Chesky explicitly stated that the era of the pure people manager is ending at Airbnb. With AI tools, data queries that used to require a team of analysts can be executed instantly via natural language prompts on self-serve dashboards.
So they are flattening the structure.
Because the rote analytical work is automated, managers, even senior directors of engineering or design, are expected to be hands-on keyboard. They're using AI coding assistants like Copilot to review and generate code alongside their teams.
So an engineer using AI isn't just typing faster.
Exactly. They are acting as an editor for AI-generated boilerplate, using AI agents to run automated regression testing overnight. It creates unprecedented leverage where a team of 3 can output the work of 30.
But let's look at the customer support side of this leverage, because handling travel disasters with AI seems incredibly risky. Resolving 40% of issues without a human sounds great for margins. But if my Airbnb is flooded with raw sewage at 2 in the morning in a foreign country, the absolute last thing I want to deal with is a clunky, hallucinating chatbot telling me to check the FAQ page.
Yeah, you want a human.
I want a human to fix my problem immediately.
Chesky acknowledged that exact anxiety, and it is why Airbnb's AI strategy is fundamentally inverted compared to their competitors. Most travel companies, Expedia, Kayak, started their AI journey at the top of the funnel. They built generic AI trip planners to help you decide where to go.
Plan a 3-day itinerary for Miami. It is a fun parlor trick, but the stakes are incredibly low. If the AI hallucinates and recommends a restaurant that closed 3 years ago, it is mildly annoying, but it doesn't ruin your life.
But Airbnb intentionally started at the bottom of the funnel with customer service mediation. This is arguably the hardest problem in commercial AI because the stakes are incredibly high. The AI cannot afford to hallucinate when someone is stranded.
Right.
It has to ingest and perfectly comprehend nearly 100 distinct corporate policies regarding refunds, cancellations, and safety. It has to instantly parse the context of a dispute between a host and a guest. It must be seamlessly multilingual, often mediating conversation where the guest is typing in Mandarin and the host is responding in Italian.
It also has to handle personally identifiable information securely. And most importantly, it needs to know exactly when it has failed and seamlessly escalate the issue to a human trust and safety officer without making the user repeat their entire story.
It is a phenomenally complex technical hurdle. They train their models on tens of thousands of past golden conversations, historical support tickets that were resolved perfectly by human agents. By solving the high-stakes bottom-of-the-funnel problem first, they achieve that 10% cost reduction.
And now that the foundation is stable, they are moving back up the funnel toward the holy grail of e-commerce: deep personalization search.
This is where Chesky was absolutely merciless in his critique of the current tech landscape. He essentially declared the current iteration of AI chatbots dead on arrival for travel planning.
He really did.
He argued that the fundamental design of a text-based chat interface is entirely wrong for e-commerce. He outlined 4 specific structural failures of current AI bots, and it completely reframes how we should think about the future of travel apps. Let's walk through his critique.
Let's do it.
The first failure is that chatbots are built on large language models, which means they are heavily biased toward outputting massive blocks of text. Travel is inherently visual. If you're booking a beach house, you do not want to read a 4-paragraph essay describing the shade of blue of the pool. You just want to see a high-resolution photo of the pool. Text is friction.
The second failure is the lack of direct manipulation. In a traditional app, if I want to see places under $200, I just drag a visual price slider with my thumb. It takes half a second.
Right.
In a chatbot interface, I have to type out a full sentence. Please only show me listings that cost less than $200 a night. Forcing the user to type commands is actually a regression in user experience. It takes more time and mental effort.
The third issue is the comparison problem. If you search for Paris on Airbnb, there are tens of thousands of listings. A user wants to rapidly scroll through dozens of options, comparing prices and photos visually. A text-based chatbot can only really feed you 3 or 4 text links before the cognitive load becomes too high and you lose the thread of the conversation.
It is an abysmal interface for cross-referencing multiple options.
And the fourth failure, which I thought was the most insightful, is the multiplayer aspect of travel. Chesky noted that 85% of people booking on Airbnb send a message to the host, and a massive portion of bookings involve coordinating with a spouse, a family, or group of friends.
Right, you're rarely deciding alone.
Exactly. Chatbots are inherently Single-player experiences, it is just you talking to a machine.
Yeah.
The AI doesn't know how to facilitate a group voting on 3 different houses.
Because of these 4 failures, Airbnb is entirely abandoning the idea of putting a chat window on their homepage. Instead, they are building an AI-native, dynamic visual interface powered by deep personalization.
This is where their walled garden strategy pays off. Because every user has an account with verified identification and a booking history, the AI has immense context. If you are booking a one-night stay in Chicago on a Tuesday in November, the AI should intuit that you are on a business trip.
It shouldn't show you a 6-bedroom house in the suburbs.
Exactly. It should dynamically restructure the app interface to instantly surface boutique hotels or small apartments near the financial district with fast Wi-Fi.
But if you open the app in April and search for a week in Tuscany with 4 guests, the app completely morphs to highlight rustic villas, local cooking experiences, and group payment options. It is about shifting from a traditional search engine where the user has to input all the parameters and do the heavy lifting to an anticipation engine that intuits your intent and visually presents the exact inventory you want before you even realize you want it.
It is a profound technological leap. If they execute it correctly, it makes traditional keyword search platforms like Google Travel look like antiquated card catalogs.
Okay, we have covered their tech stack and their daily operations, but Airbnb has one final massive strategic lever that they pull intermittently, and it is crucial for their supply growth. Let's look at the big event playbook. They rely on massive global spectacles to acquire new hosts in a way that completely defies traditional marketing economics.
It is worth remembering that Airbnb was literally founded on this premise. Brian Chesky and Joe Gebbia rented out air mattresses in their apartment because a massive design conference had sold out all the hotels in San Francisco. Capitalizing on acute localized supply shortages is encoded in their corporate DNA.
We just saw the ultimate validation of this playbook with the Paris Olympics. The data they provided is incredible. The strategy worked flawlessly. During the Olympics, they saw massive spikes in bookings, but the real victory was host retention.
The retention numbers were crazy.
Over half of the people in Paris who listed their homes for the very first time specifically to capitalize on the Olympic rush were still actively hosting on the platform 6 months later. And during the recent Winter Olympics in Italy, they accommodated 200,000 guests, and the gross booking value in the host markets more than tripled.
And now they are scaling that up.
Right. They are deploying this exact blueprint for the 2026 World Cup, which is unprecedented in scale because it spans 16 cities across 3 countries in North America. They have already added 100,000 new hosts in those markets, specifically in anticipation of the games.
To understand why this is so powerful, you have to look at customer acquisition cost, or in this case, supply acquisition cost. Normally, convincing a homeowner to allow strangers to sleep in their bed requires massive marketing spend. You have to run targeted ads, offer financial guarantees, and educate them on the process. It is expensive and slow.
But when a mega event like the World Cup comes to town, the macroeconomic reality does the marketing for them.
Exactly. The local news stations run segments for months about the massive hotel shortage. The mayors of these cities go on television and literally plead with residents to open their homes to accommodate the influx of tourists.
It's basically free PR.
Homeowners realize they can charge hyperinflated peak demand pricing and make thousands of dollars in a single week. The friction of adopting the platform vanishes because the financial incentive is so overwhelmingly high.
They sign up for a quick, opportunistic cash grab. But the genius of Airbnb's model is that they don't actually need all 100,000 of those new hosts to stay on the platform forever to consider it a success. The World Cup is a temporary elasticity test.
Right.
But what happens is a significant percentage of those people, like the 50% in Paris, go through the process, realize the app handles the insurance, the payments, and the communication, and they realize it wasn't nearly as difficult or scary as they assumed.
So they leave the listing active. It is a Trojan horse for host acquisition. They use the artificial scarcity of a 2-week sporting event to permanently step up their baseline supply of inventory in major global hubs, all while spending a fraction of what traditional marketing would cost.
We have covered a staggering amount of operational ground. They have a $1.7 billion cash war chest. They are driving users to a closed-loop app. They are utilizing deferred payments to increase transaction sizes. They are successfully penetrating complex international markets through hyper-localization. They are moving into hotel inventory to bypass regulations. And their AI integration is actively collapsing their cost structure.
It paints a picture of a flawless machine.
But Wall Street is not in the business business of rewarding past performance. They only care about what happens tomorrow. Which brings us to the management guidance section of our breakdown. This is where we see how all of these brilliant strategies translate into near-term financial projections.
And this quarter, the guidance presented a massive paradox that we need to untangle.
Let's look at the immediate short term, the Q2 2026 outlook. Management stated they expect Q2 revenue to land between $3.54 billion and $3.6 billion. They expect gross booking value to be up in the low to double digits year over year. But here is the massive caveat, the sentence that always sends algorithms into a selling frenzy.
The D word.
Management explicitly warned that the growth in nights and seats booked will decelerate slightly from the 9% growth we just analyzed in Q1.
Decelerate. In the hyper-caffeinated world of growth tech investing, decelerate is a toxic word. It triggers immediate anxiety. Wall Street is modeling exponential growth, and any indication that the sheer volume of human beings booking trips is slowing down is viewed as a crack in the foundation.
Why is the volume decelerating? And more importantly, if the volume of bookings is slowing down, how are they still projecting such robust top-line revenue numbers for the quarter?
The deceleration in nights booked is driven by a confluence of factors, both internal and external. Externally, the geopolitical instability in the Middle East is creating a prolonged drag on consumer confidence and flight routing across the entire EMEA and APAC regions. That is a macroeconomic reality that Airbnb cannot code its way out of.
And internally, they are running into the law of large numbers combined with incredibly difficult year-over-year comparisons.
Exactly. Last year, they rolled out the Reserve Now, Pay Later feature globally, which triggered a massive anomalous spike in bookings. When you have a monumental growth quarter driven by a new product launch, the mathematical reality is that matching or exceeding that percentage growth the following year becomes incredibly difficult. They are victims of their own success in that regard.
Right. But what about the revenue?
The reason revenue is remaining highly robust despite the softening volume comes back to pricing power and global economics. They are projecting a 3% foreign exchange tailwind in Q2. Because the dollar is moving favorably for them, the international revenue translates into higher reported dollars. Furthermore, their average daily rates are remaining incredibly resilient.
So it balances out.
So even if the physical count of bookings slows down a fraction of a percent, the amount users are paying per night, combined with favorable currency math, keeps the top-line revenue safely within Wall Street's expectations.
Okay, so Q2 looks a bit sluggish on volume, but safe on revenue. But here is where the narrative paradox occurs. Let's look at the full year 2026 outlook. Despite explicitly warning about a Q2 deceleration, management actually raised their financial guidance for the entire year.
Which is wild.
They expect full-year revenue growth to accelerate into the low to mid-teens. And they raised their adjusted EBITDA margin projection, committing to at least 35% for the full year.
Right.
I have to ask the obvious question here. They are telling us that fewer people are booking trips in the immediate next 90 days, but simultaneously promising that the entire year is going to be more profitable than they originally thought. How does that math work for the retail investor? Are they just attempting to distract from a weak quarter by promising a magical recovery in December?
It is the natural skeptical response. It sounds contradictory on its face, but the CFO laid out a highly methodical, three-part logical framework explaining exactly how they achieve an accelerated full-year result despite a softer Q2.
Walk me through the mechanics of that framework.
The first element is visibility. Because of the Reserve Now, Pay Later feature, booking windows have lengthened dramatically. Consumers are securing their fall and winter holidays right now. This gives Airbnb unprecedented data visibility into the back half of the year.
They aren't guessing about demand in Q3 and Q4?
Right. They already have the reservations sitting in their database. The pipeline is quantifiably packed. The second element is pricing stability. They have modeled out the global inventory, and they do not foresee any macroeconomic collapse that would force hosts to slash average daily rates. They believe the pricing floor is solid.
And the third reason?
The third reason is the absolute key to the entire paradox, and it is vital for investors to comprehend. They are actively increasing their overall take rate through structural monetization changes.
Let's clearly define the take rate. If the gross booking value is the total amount of money floating around the casino, the take rate is the exact percentage the house keeps on every single hand played. It is the ratio of revenue to GBV. How exactly are they squeezing a higher percentage out of the ecosystem without triggering a revolt from their hosts or guests?
They are executing a structural shift with a specific segment of their supply base known as API hosts. An API host is a professional property management company. They are a guy renting out his basement. They are sophisticated operations managing 50 or 100 properties using complex third-party software that plugs directly into Airbnb's back-end servers via an API.
The power users of the platform.
Exactly. Historically, Airbnb utilized a split fee model for everyone. They would charge a small service fee to the host and a larger service fee to the guest at checkout. But they are aggressively migrating these professional API hosts to a simplified single service fee model.
Okay.
Under this new structure, the host pays the entire fee, usually around 15%, and the guest pays absolutely zero service fee at checkout.
On the surface, that sounds like a terrible deal for the host. If you tell a property manager that their fee is jumping from 3% to 15%, they should be furious. Why would they agree to this?
Because professional property managers value total pricing control above all else. In the old split fee model, a host would set their nightly rate at $200. But Airbnb would tack on their own guest service fee, and the final price the guest saw at checkout would be $230. The host had zero control over that final sticker shock, which often led to abandoned carts and lower conversion rates.
Ah, I see.
Under the single service fee, the host absorbs the fee but sets the final all-in price themselves. They price it at $230. They know exactly what their profit margin is, and the guest sees a clean, transparent price with no hidden service fees tacked on at the end. It drastically improves the checkout conversion rate.
And more importantly, for Airbnb's guidance paradox, this single service fee structure mathematically results in a slightly higher overall take rate for the platform. When you combine that with the rollout of new, highly profitable ancillary products like offering specialized insurance directly to hosts or allowing hosts to pay for sponsored listing placement, the margin expands.
Right.
They don't necessarily need exponential growth in the raw number of nights booked. If they simply extract a slightly larger, more efficient slice of the pie on the tens of millions of nights that are booked, their total revenue and EBITDA accelerate exactly as guided.
The balance sheet provides the ultimate safety net here. Because they're generating $1.7 billion in free cash flow, they have the luxury of simultaneously raising their margin guidance to 35% while aggressively reinvesting capital into Project Hawaii marketing and their massive AI overhaul. They are entirely self-funding their own reinvention.
We have dissected the headline numbers, we have explored the mechanics of the app, the Trojan horse strategy, the AI-driven founder mode, and the nuances of their forward guidance. We have to synthesize all of this data into a definitive verdict. It is time for the bottom line. Based on the underlying mechanics of everything we have discussed, we have to take a position on the reality of this stock for the retail investor.
What's your take?
I am taking a decidedly bullish stance on Airbnb following this quarter. I came into this analysis highly skeptical of the decelerating volume growth. A 9% growth rate in nights booked is not the hyper-growth story of 2021, but when you look at the fundamental architecture of the business, it is incredibly robust.
If we synthesize the bull case, it rests entirely on capital efficiency and operational leverage. The company is a cash-printing anomaly. Generating $4.5 billion in trailing free cash flow provides near invulnerability to sudden macroeconomic shocks.
They can weather almost anything.
If the global economy enters a recession tomorrow, Airbnb does not have to worry about defaulting on hotel leases or paying thousands of idle housekeepers. They simply scale back server space and ride it out. Furthermore, they're taking that cash and reducing the outstanding share count by billions of dollars, mathematically increasing the equity value for every retail investor holding the stock.
And the AI integration narrative is real. It isn't a marketing gimmick designed to appease analysts. They are actively lowering the operational costs of every single booking by 10% in an environment where inflation is punishing everyone else. They are replacing layers of middle management with highly leveraged AI-assisted engineering teams.
Right.
They have a massive untapped runway in expansion markets like Brazil and Japan, and they are successfully penetrating the massive hotel total addressable market to acquire older, hesitant demographics.
However, intellectual honesty requires us to acknowledge the very real bear case. The risks to this thesis are not insignificant. The deceleration in nights booked cannot be entirely hand-waved away by tough comparisons. If that 9% volume growth continues to trend downward and stalls out completely at zero or negative growth, no amount of financial engineering, share buybacks, or take rate optimization can save a growth stock multiple.
Right, the stock would get crushed.
Wall Street will aggressively re-rate the stock downward. The geopolitical headwinds in the Middle East and Europe remain unpredictable and could easily worsen, freezing international travel. And they must execute perfectly in the back half of the year to hit that raised guidance. If the pipeline they are boasting about evaporates, the stock will be punished severely.
So, taking both sides into account, here is the actionable advice for you, the listener. If you are currently holding Airbnb stock in your portfolio, the fortress balance sheet, the massive cash flow, and management's ruthless commitment to maintaining a 35% margin offer a very strong safety net. You own a highly profitable, mature platform that is actively returning capital to you through buybacks while funding its own growth.
And if you don't own it?
If you do not own the stock and are considering initiating a position, your mental model of the company needs to shift. Do not evaluate Airbnb purely as an alternative accommodation platform competing with VRBO. You need to view them as a high-margin, asset-light tech platform that is currently attempting to build the foundational AI-driven infrastructure for the entire global travel ecosystem. They are using homes as the initial wedge to eventually capture every dollar spent on a trip.
It is a highly ambitious transition, but they have the capital and the management discipline to execute it.
Which brings us to the end of our deep dive. You came in looking for the headline earnings numbers, but hopefully you are walking away with a much deeper understanding of the hidden mechanics driving Airbnb's growth engine, from unearned fees and foreign exchange impacts to localized UI tweaks and single service fee structures.
There's a lot to process.
It is, but before we sign off, I want to zoom out from the immediate quarter and leave you with a final provocative thought about the existential future of the entire internet. We spent a significant amount of time analyzing Brian Chesky's brutal critique of current AI technology. He noted that text-heavy chatbots simply fail at the visual, multiplayer reality of e-commerce. He is betting the entire future of the company on building an entirely new, AI-native, deeply personalized visual interface.
It could change everything.
So here is the question I want you to mull over. If Airbnb successfully invents this first truly dynamic, highly personalized AI interface, an interface that doesn't require you to type a single search query, but simply opens your phone, intuits exactly what kind of trip you want based on your history, knows who you are traveling with, and instantly visualizes the perfect itinerary and boutique hotel at the exact price point you can afford, do traditional text-based search engines and legacy ACAs. Online travel agencies even stand a chance over the next decade.
That's the billion-dollar question.
Or does the entire multi-trillion-dollar online travel ecosystem eventually get swallowed whole by the first platform that figures out how to make AI anticipate our desires rather than just answering our prompts? Think about the mechanics of your own behavior the next time you open a browser to book a trip. Thanks for joining us on this Talk Tickers Deep Dive.